Thank you for joining me again today for another Business of Trucking video. Now, whether you're already a self-employed truck driver, any kind of self-employed for that matter, really any business, but I'll talk about trucking because that's the business I'm in. Or maybe you're a company driver, you're thinking about becoming an owner-operator, and you say, well, I don't want to lose all my benefits. I got health insurance, I got a 401k, company match, I got all these things. Well, health insurance is definitely one to be concerned about. You need to iron that out before you even think about going out and being an owner-operator. And if your spouse is working, maybe they can get you on their plan. Otherwise, don't take that leap until you've nailed down health insurance. And it's hard for anybody to give you advice on that because it's very different for every person and every family. But today we're going to talk about retirement plans. You might say, I don't want to give up my 401k. I got this great company match and make money in it. I can put all this money into my $19,500 a year into my 401k. Why would I give that up? That's like money in the bank. Well, as self-employed, you have a whole world of options available to you. I don't care a mess about a 401k as an employee because as far as I'm concerned, as a self-employed person, even though you're not going to get that company match, you have way more options, way better options. As an employee with a 401k, you have maybe what the typical 401k has, maybe 8 to 10 options of different mutual funds and stuff like that. The fees are exceedingly high in 401ks. Whereas being self-employed, you have tens of thousands of options. You don't even have to stick to mutual funds and bonds. You can do real estate. You can do, the options are never ending. Even if you don't care much about this, a retirement plan should be part of your overall tax planning as an owner-operator or a self-employed person in general. So if you're not really familiar, let's talk about some different options that you have available to you. And then we're going to pick out the most attractive options for people like you and me. And we're going to go through some of the finer details of them. Now, when I say people like me and you, I'm kind of gearing this towards the individual truck owner or a very, very small fleet with an owner and then just maybe a couple employees. Not even so much for that, but it will work for that. So let's talk about these details. Like I said, as a part of your overall tax plan, there's some real opportunity here and it's a must. So let's take a look. By the way, if you like this kind of thing, make sure you hit that like button and subscribe. Share it with a friend. Really helps me get my videos out to more people and grow the channel. I really appreciate that. So let's take a look here at probably the most popular options we have available to self-employed people. Forgot my marker here. Number one is an IRA and a Roth IRA. Now, these things are not just for the self-employed. These are for anybody. Self-employed, employee, whatever. So we're going to definitely go through those first. A KEOG. A KEOG is a plan they used to use kind of to distinguish a corporation from a non-corporation. They're kind of obsolete, so we're scratching that off the list. Solo 401k. This one we're going to talk about. That's a viable option for a lot of people. And it also has a Roth option, and we'll talk about what that means here in a little bit. Simple IRA. Simple IRA is the Savings Incentive Match Plan for Employees. IRA. Now this would apply to you more if you had some employees, which most of us aren't going to have. So we're going to scratch that off. It's not a bad one, but it's just not going to apply to most of us. The SEP IRA. This is a very good option. I use a SEP IRA, and we're going to compare that kind of to the solo 401k, see what's best for you. A SAR-SEP, that's another plan that kind of is for somebody with employees, maybe even a few more employees than the simple. So we're scratching that off. That doesn't apply. Defined benefit plan, ain't no way we're doing that. It's complicated, and defined benefit plan must be contributed to in certain amounts every year, whether you make money or profitable or not. And as a small business, there's no guarantee that we're going to make a profit every single year. So we're not a union shop here. We're not doing a defined benefit plan. So let's kind of compare some of these different options here. Okay, so first we're going to compare a Roth IRA and what's a traditional IRA. Now, like as I said, even employees qualify for this, so this applies to everybody. If you have an earned income, you can contribute up to these limits, okay? So a Roth IRA, contribution limit is $6,000 per year, and if you're 50 or older, you get a catch-up of $1,000, so you can put a $7,000 per year in. The contribution limits are the same for the traditional IRA, and all these numbers pertain to 2020. A lot of times they change every year. So 6,000 and 7,000 if you're 50 plus. Now, the ability to contribute to a Roth, if you're married filing jointly, starts to phase out at $196,000. These amounts will be diminished. Over here in a traditional, married filing jointly starts to phase out at $104,000. Okay, so if you make too much money to qualify, chances are you'll probably fall in this category. And you can also make what are called non-deductible contributions. It's up to you. Talk to your tax professional about that. Now over here on the Roth, your contributions, the money you put in, is taxed as ordinary income. And then it grows tax-free. You never pay any taxes again on that money, even at withdrawal. Over here on the traditional, your contributions are tax deductible, which means it lowers your taxable income. They will take less taxes out of your check. Or you'll pay less taxes at the end of the year, however you do it. This grows tax deferred, which means the taxes are delayed until retirement. Then as you withdraw, you're taxed on the withdrawals. And you're taxed at ordinary income levels for that, whatever your tax rate is at that time. RMDs are required minimum distributions. So with the Roth, there's no required minimum distributions. You never have to take the money out if you don't want to. If you have so much money, you have a pile of money, and you just want to leave it for your heirs or continue to grow, whatever, you don't have to take the money out. With the traditional IRA, you have required minimum distributions, and you will pay taxes on them. So, logically, the Roth is a better idea, but you kind of got to evaluate your situation as a whole to see what works for you. And you can do a combination of the two. You can do 3,000 in a Roth and 3,000 in a traditional. You can do 1,000 here, 5,000 here. You could put 500 in and nothing else. Whatever you want to do, as long as you don't violate these income limits. Okay? So, with the Roth, you can withdraw your contributions, your original contributions, early without taxes or penalties. It's kind of a big deal. It's if you put money in there and you're only 50 years old and the money's been in there a while and you have an emergency come up and you need surgery or something, you can withdraw your original contributions without tax or penalty. Now you can't touch the growth. Any money that you've earned, you will be taxed and penalized, but you can withdraw the principal. Over here, you will be taxed and penalized for early withdrawal. So it's the best idea to not touch this money early anyway, but in case of whatever situation you may get in. Now, if your spouse has an earned income, they can also do one of these. If you're self-employed and your spouse does not earn an income outside the home, does not have a job, you may qualify for what's called a spousal IRA. If you make enough money to cover both, if you want to put $6,000 in, you'd have to make a minimum of $6,000 taxable for the year. So if you wanted to do one for your spouse too, you would have to earn enough to cover that also. So between the two of you, you could put away $12,000 a year or $14,000 a year if you're 50 or older. So that comes back to the point of managing your tax situation. If you have a heavy income now and you need to reduce your taxes, whatever you've talked it over with your tax planner, right here you could stash away $12,000 or $14,000 tax deferred right now and take a tax deduction for that. I do a little bit of both personally, mostly over here in the Roth. I may use some traditional over here to get me down into the next lower tax bracket if I'm close, within a few $100s or a couple $1,000s. may put some money in here just to creep down into that next tax bracket. So this is the kind of strategies to employ. Next, let's get into and talk about the solo 401k versus the SEP IRA. Okay, so SEP IRA, SEP stands for Simplified Employee Pension. IRA is Individual Retirement Account. So with the SEP IRA, there's some differences and some similarities between the two here. With a SEP IRA, you can put away 25% of your net earned income up to a $57,000 maximum contribution. So to contribute the maximum, you would have to contribute or earn 4 times 57,000. And then you could contribute the full 57,000. Now that's net earned income, not gross, okay? So say your net earned income was $100,000. 25% of that is $25,000. So that's a pretty substantial contribution. Now with the SEP, all contributions are tax deductible, so you can reduce the amount of your taxable income in that tax year. However, it does not reduce your self-employment tax. But that doesn't mean that it's not worth doing, because you can still substantially reduce your taxes. Now with the SEP, the growth is tax deferred. So it's tax deductible in the beginning, the money grows tax deferred, and you will be taxed at withdrawal. With the SEP, there is no annual reporting required to the government. It will work for employees. So if you have employees, you can use this as a retirement plan for them. Okay? Now, if you're going to do it with employees, you must contribute equal amounts for all employees. So if you're just one guy with one employee and you want to load up your own retirement fund and maybe not put as much in theirs, that's not going to work. You have to contribute equal amounts to all of them. That's just the way the rules are. So with a solo 401k, it would work like a traditional. However, with the solo 401k, there's also a Roth option. Now, if you remember from the IRA discussion, the traditional and the Roth option, they're different. One's tax deferred, one's tax free. Okay, so you can make that option. You can make that choice over here at the solo 401k. The contribution limits are a bit more complicated. Well, everything's a bit more complicated with this, but there could be some upsides too. So you still have a maximum contribution limit of $57,000. Plus, if you're 50 or older, you can do a catch-up contribution for $6,500. Once again, this is based on the tax year of 2020. These numbers can change every year. However, it's not just quite that clean and simple here. You have to kind of look at two sides of it. One, you look at yourself as the employee, and then you also look at yourself as the employer. So, as the employee side of it, you can contribute a maximum of $19,500, plus if you're 50 or older, an additional $6,500. Now, on the employer side of it, you can contribute 25% of your compensation as an employee. And this is now, so say you earned $100,000, 25% of that would be $25,000 is what you could contribute on the employer side. Then in addition to this, can't go over this amount. So you have to keep close track of that. So once again, the maximum combined between employee and employer, the maximum contribution is $57,000. Or, like I said, if you're 50 plus, the additional $6,500 would bring you to $63,500 maximum between the two sides of the contribution. And once again, this is also on net income. Now for both of these, they're based on a retirement age of 59 and a half would be when you could start withdrawing money with no problems for retirement. Like I said, there's a Roth or a traditional option here in the solo. Similar rules apply that we talked about for the IRAs as far as tax treatment. With the solo 401k, there is some yearly reporting requirements to the government. So you'll have to fill out some forms. What exactly they need to know, I'm not exactly sure. I've never done it. Part of the reason I did not select this account because I don't want to be doing stuff like that. I use the SEP account for me. I can't make enough to put that much money in anyways. So the solo 401k does not work for employees. So if you have employees that you're looking to sponsor their retirement account, the solo 401k is not for you. You would want to pick, a SEP, a 401k, a simple IRA, a SAR-SEP, something like that. Something unique with the solo 401k is there is a potential to have an account for your spouse. If your spouse works outside the home, has a job, and like a 401k at their job or some kind of IRA, then no, you would kind of be double dipping on that. But if your spouse works in the business and they take a salary, say they do your dispatching, your billing, your load planning, all that kind of stuff, basically your whole office person, and that there's a legitimate employee in the business, then you can also contribute money for them if you make enough, if you make enough profit. Potentially, if you made enough money, you could double that, the $57,000 or the $63,500. You would have to make a lot of money to get this done. Let's see here, right around, it would be $400,000 plus a year of net earnings. Somebody out there is probably doing that. I certainly am not. But I suppose some specialized people or household good movers, maybe they're a team operation making that kind of money. I don't know. But the potential is there. So you can start to see, you can put away substantial amounts of money and use these strategies to reduce your taxes. And the best part is you get to keep the money. It's yours. So saying that I have to go out and spend all this money on something I don't need, like buying a new truck when I don't need to, or it doesn't make any sense, or trailer, or what have you, when it just doesn't make any sense, you don't need these things, there are other options. So this should be very much a part of your tax planning every year. Sit down with your accountant. They got computer software, TurboTax and stuff, professional grades of it that can run all these numbers for you, tell you how much you are eligible to put away. Definitely work with them. Work with a retirement planning professional, and no reason why you can't keep some of this money. And don't get me wrong, if you need a new truck, if you need a new trailer, that's totally different. It makes sense to implement a strategy like that, but to go out and spend money and buy things when you don't need to, just for the sake of reducing your taxes, is not the best planning in the world. So I hope this helps add some options to your life here. And if you like this kind of thing, make sure you subscribe, hit that like button, and we will see you next time.